Welcome back, investors, to Ticker Time News. I'm Adam, and SoFi has a warning, and their shares have even slipped 2.8% here in after-hours trading after the fintech company said that SoftBank decided to sell some or even all of its stake in SoFi. SoftBank holds more than 83 million shares of SoFi's shares outstanding, or about a 9% stake in the company. The shares may be sold in the open market or even private transactions. In fact, shares have already begun to have been sold. On August 5th, SoftBank sold 5.38 million shares of SoFi at an average price of $7.99. On August the 6th, it sold 6.68 million more shares at an average price of $8.17 per share. So if SoftBank is selling all of its shares in SoFi, this would cause a big hit to SoFi's share price. Now, just this news alone is causing shareholders to take some profits. We can see it with the 2.8% down in the after hours. We'll keep following this story to see if SoftBank is completely out of SoFi, or maybe they're simply taking profits after a 60% move higher in SoFi over the last month. So we'll keep this one on our radar and closely watch it. Technical structure of SoFi, that gray bar across your screen there, average is probably about where it is right now at about $7.75 a share. That is steep in strong resistance. It's like a steel bar saying, nope, you're not getting through us. So with that in mind, maybe now is a good time to take those profits that you may have made over the past month in SoFi, if you haven't already, of course, because it does seem like the short squeeze may be over, at least temporarily, right? Until the shorts have reloaded, which could take a few days, a few weeks, or even a few months. But nevertheless, this SoftBank news is a bit concerning. So we'll keep it up and watch it. All right, moving on to another company that's moving in the after hours, and that is Upstart, ticker symbol UPST. And this one, it's not so good. Upstart issued Q3 guidance that fell way behind expectations, and they did not provide full year guidance, as tighter financial conditions actually ruined their Q2 results. Now, Upstart, which provides a lending platform to banks, expects its Q3 revenue of about 170 million. That is far below expectations of 246 million. Now, during the quarter, Upstart's bank partners originated 321,138 loans, totaling $3.3 billion across its platform. Yeah, that seems pretty good, right? Well, when you compare it to Q1, there was 465,537 loans originated at $4.5 billion. That's a $1.2 billion difference in just one quarter, and financial conditions are not going to improve anytime soon. So that's SoFi. And here in the after hours, investors are not liking it, as Upstart is now down nearly 10% after being up just over 9% during the regular session. So those gains during the regular session are completely washed away, and it is sinking further. Now, one thing I'll point out here on the chart for Upstart, financial conditions are not improving, and they're not going to for a while. We're in a technical recession. How deep is this going to go? Yields are inverted. Banks never like that. There was a base, at least over the past month, right here. Let me get the highlighter real quick so that way we can all know what spot I'm talking about. Right here, there were 2 times Upstart tagged what seemed to be a bottom and maybe was trying to start to build out a bit of a base. So if SoFi continues to fall and price is already halfway there, what's it going to do when it reaches, say, about $22.25 a share? Can it bounce at that position? If so, then there is a good amount of buyers at that price point. But of course, if it dips below that, then there's no floor. It can fall until it decides, or investors decide that, well, now is good value for Upstart, which is a growth company, a startup. Okay, now there are two companies that I want to bring to your attention who are soaring in the after hours. First up is Lemonade. Ticker symbol is LMND. Lemonade reported its earnings and its Q3 revenue guidance, now including the impact of its Metro Mile acquisition, topped expectations pretty nicely. And the tech-focused insurer, it moderated its growth spending and hiring pace to deal with inflation. And there it is. Another red flag that most market participants are either flat out ignoring or they're missing it in this slowdown. And what is that red flag? Slowdown in hiring. We see it from so many companies right now. They're slowing their hiring. They're cutting down costs. They're budgeting better. And what are they doing this for? A recession that worsens, that gets much, much worse than we are now, not just a paper one. Now, our investor community is not behind the 8 ball on this. And if you would like to get instant access to our weekly expected moves, numerous trade setups, our top 10 stocks in 4 different categories, market insights, and more to help you achieve your financial goals, then click the first link in the description and join investors just like you and me who are fighting for financial independence. Now, on to the second stock that I was talking about that is launching in the after hours. That's GoodRx. Ticker symbol is GDRX. This is a drug savings platform. I personally use it. I go to Walgreens or Giant, whatever pharmacy it may be, and you can get your prescriptions for a much cheaper price. Even if you have insurance, sometimes paying cash with their discounts is actually cheaper than your own insurance program. So I use it. I find it to be pretty incredible. There was a big story with it, gee golly, over a year, maybe 2 years now, at least a year and a half ago, when Amazon started its pharmacy. GoodRx sunk, but GoodRx is not sinking here in the after hours. It is up 52%. The candle would be all the way up here. Huge gap up. Now, they beat expectations with its Q2 2022 financials, and it announced that its previously disclosed grocer issue has now been resolved. So more people can now use it at more places. And boom, there you have it. That's why it is up over 52% in the after hours. How's it going? Adam, when do you see these companies guiding down? They're starting to. It's a small fringe group almost that seems to be guiding down, but it's happening. And I do believe this is not going to be a all at once. All companies decide, you know what, we better be for real and lower our guidance there a little bit. It's just going to be a leaky faucet. A few will come out every once in a while, and then that leaky faucet will begin to become an annoyance as more and more and more companies do it. And then eventually, most companies are going to have to face the reality that this is not going to be a simple paper recession, and their current data is going to guide them on that decision, saying, hey, you know what? Things aren't that great. Maybe it's a stagflation environment. Maybe inflation just is a nagging, persistent thorn in the side of the Fed and just doesn't come down as quickly as it could or as quickly as the Fed would want it to, and rates have to remain higher, slowing down growth even more, and it just on and on and on it goes. So I do think a small little trickle, but it will become bigger and bigger as we move forward and forward, as we get closer to Q3, as we get closer even to Q4. I think that's when the majority of companies will have faced the music, Q4 that is. Finally, guiding down. Yep, I understood what you were asking there. So again, a slow trickle, slowly more and more. And then once we get to past Q3 and into Q4, I think that's when the majority of companies will have to come out and face the music. All right. Remember, as I'm going through what happened in the market, what I saw, what I thought was interesting, why things happened, and what to expect, don't forget, plug your questions in, and we'll go through them throughout the show. That's what this live stream is for. The live stream is for you. So if you have a question, don't feel shy. Plug it in there, and we'll talk about it. Okay, let's talk about the broader market. Now that I mentioned those few companies there, smaller cap companies, the S&P 500, the SPX, SPY, the SPY, it's moving in a more neutral stance right now. With the 5-day EMA, which is the most frequently tagged moving average, obviously it's a short one, only 5 days. I know it's tough to see here on the chart. I'm trying to make it a little bit bigger so it's a little easier to see. This is a daily chart, but this blue line that is following the candles up right here, whenever candles get away from this blue line, just like it did right here, then you can expect over the next couple of days, even the very next day, for it to be red so it can come back and tag that 5-day EMA. And then we move up here and same thing happened. We moved away from it. So here we fell and gapped down to it. Now, today, we have pulled back and we are touching it. We are right on the 5-day EMA. Price has just been chopping around. Now, this price action is eerily similar. And I've said this before many, many times. It is eerily similar to the end of May, beginning of June contraction phase that came right before the huge expansion downward. Now, that time around, it sank on CPI data that had inflation numbers coming in hotter than expected. Now, it's time to fade this bear market bounce if you haven't already, and I believe prepare for the next leg down. Now, I don't want to sound like I'm spreading FUD, fear, uncertainty, or doubt. I just want to be honest and real with what I'm seeing. Now, if we back up here a little bit, I want you to focus on two sections. First is this section right here, okay? And then where we are at right now, okay? History does not repeat. However, history does rhyme. So you can always find chart patterns that have happened in the past that line up and look pretty darn good for how they're going to play out in the future. As a matter of fact, I told our investors on Patreon last night that I thought today would be green, following what happened during this time frame at the end of May and the beginning of June. Every day, 1, 2, 3, 4, 5, 6, 7, 8 sessions in a row have played out exactly how they have over the past 8 sessions compared to the 8-session period that started with the big run up here and then the consolidation. So on the 9th day, it was a green day. That's why I thought today would be green. But that's just another lesson that history does not repeat, but it rhymes, okay? And today it wasn't a big move, down 0.12%, 0.12% down for the S&P 500, 0.12% down for the SPY, 0.32% down for the Qs, and the Dow Jones was actually up 0.14%. So a flat day. I could have very easily been right with it being green. Just a 0.1%. That's it. Now, looking ahead, we have got inflation data coming up on Wednesday. So we have 1.5 trading sessions left before we get that inflation data. And is it going to be hot? Have we come into peak inflation? Has inflation started to inflect down? This question will be answered on Wednesday. Now, I don't think inflation will come in super hot. Like, I don't think we're going to get a 10% reading for the CPI, Consumer Price Index. I don't think we'll get 10% because a lot of commodities have come down, especially oil. When you look at oil, oil has dropped significantly from a month ago. And even though it takes time to work through our system, our economy, and show up in the CPI report, in the numbers, it will. Whether it does it this time or next time, it'll show up. Other commodity prices besides oil have also fallen. I believe lumber is under $500, which puts it at close to a 2-year low. So there's good signs out there pointing to inflation coming down. However, my warning would be, even if we don't get 10%, say we get expectation somewhere of 8.9 to 8.1%, that may be below expectation, but that's still a very high inflation number. And that means it's hurting a lot of people, right? So the Fed wants inflation to come down to an average of 2%. If inflation reading on Wednesday comes in at 8.5%, that's nowhere close. And this rally that we have just experienced, the July rally, was front-runted on the idea, and let me just raise this up. I always do that, don't I? I always do that, ladies and gentlemen. Forget that the highlighter's on when I want to move the chart. Okay, this July rally that we just came through, we can go all the way back here to June 17th in this bottom, and it is just a run up just like that, right? This rally was front-runned by the idea that we have reached peak inflation. Therefore, the idea was that the Fed would pivot. And every time, going back, looking at every time the Fed has pivoted in recent history, the markets have rallied. Because what does that mean? When the Fed pivots, that means the Fed is going from raising rates, which slows the economy, to lowering rates, which helps to speed up the economy. It ain't going to happen. My thesis doesn't say so. And again, I'm not trying to be fuddish. I'm just trying to be real and honest about it. 8.5% is a big reading for inflation. That may be under expectation, but that means the Fed still has work to do. And the Fed will continue to raise rates until that inflation number is coming back down to the average of 2% per year. Just getting that off my chest. Hope I didn't bore you with it. But it's what I'm seeing. Fed pivot, in my mind, it ain't happening. And that means since this rally was front-runted on that idea, what's going to happen when the Feds do raise rates? We're going to get this right here, this giant fall all over again. All over again. We're going to get that again. Okay. Doom and gloom. Don't like it, but we have to be honest. Now, we talked about the inflation number. Even if it's high, the Fed won't pivot. So just keep that in mind. Fed pivots are important. And when the Fed does pivot, that will lead to a sustained rally. Okay. Let's keep running down the ideas I have here on my notepad. Okay. Next up, the strong jobs report on Friday. I just want to mention that for a moment because we didn't do a live stream during it. We had a big old thunderstorm, lost electricity, yada, yada, yada. The jobs report was strong, much stronger than I anticipated. However, a strong jobs report plays into the narrative that the Fed will not pivot. Why would it need to pivot? If the economy is strong, if employment is strong, which the Friday report showed that jobs were strong, why would the Fed pivot? The Fed needs to lower inflation. And if the economy is strong, and I'll put it in quotation marks, there's no reason for the Fed to stop raising rates. Now, let me point out, though, that the jobs report on Friday is a lagging indicator, meaning it's looking in the rearview mirror and it's telling us what happened back there. The stock market does not move forward based on what's behind us. The stock market moves forward based on what's happening right now and what's going to happen in the future. So, we know right now companies are laying off. Companies are slowing down their hiring. Companies are withdrawing. They may have had applicants reviewing them. Sorry, not hiring now. And they stop and they withdraw from the process. This shows the economy is slowing. It shows that the consumer is weakening. Those things could slow the Fed down. Could. Most likely not. My thesis says no. The Fed's not slowing down. Not yet. Not yet. Okay. My question is, what number does the market like? The market has just been ignoring any negative news. Okay. To answer that question, let's talk about it for a moment. Good news has been looked at as good news. Bad news has been looked at through the lens of not as bad as feared, meaning some market participants think that even bad news, well, that bad news could have been better. It could have been worse. We're lucky we got what we got. So it's good news. That is either a pessimist or an optimist. And those two characteristics don't do very well in the market. The realist is the one who overachieves in the market. So with this not as bad as feared, hey, things could have been worse, right? With that mentality, and also the mentality that the Fed is going to pivot, that's the big one. When you want to understand the question at hand, why are market participants ignoring negative news? it all came down to really one fundamental, besides the not as bad as feared, it could have been worse. It's that the Fed, they're going to pivot. If things really are this bad, and there's two very distinctive narratives out there. There's the camp that says the economy is awesome. The economy is doing great. And let's, by the way, redefine what a recession is. There's that camp. And then there's the camp that says, no, we can see companies are laying off workers. We can see companies who got awfully greedy during the high demand phase that we were in coming off the pandemic, hire a bunch of people thinking it's going to continue when it didn't. So now they have to lay off all those people. And a special thank you to one of our investors on Patreon who shared a video with me. I'll share it with our with our other members on Patreon after the live stream. But it's a tech news type of YouTube show. And about halfway through, he's talking about some people have contacted him about working at a few technology companies, and they're being laid off. Why would these big technology companies be laying off workers if the economy is so good? Like one camp says it is. Well, it can't. That's just the facade. It's not really that great. So, with the jobs report from Friday being a lagging indicator, meaning it happened already in the past, we're already moving forward, and we know that the unemployment situation, we get numbers every week, is growing, meaning more people are seeking jobless benefits, more people are being laid off. Every single week, that number is slowly ticking up. It just hasn't reached a, I don't know what word to use. I drew a blank in my mind. Any sort of mass layoffs. I guess that's what I'm trying to describe here. That affects the unemployment rate. So as we move forward, these jobs reports that we get every month, like we got last Friday, they are not going to be so cheerful and rosy as we continue to move forward in time. I know I'm getting a little off track here on your question, but I'm trying to explain the bigger picture of what we're seeing. The market was front run on the belief the Fed would pivot. With a reverse looking jobs report from Friday, that got investors thinking that, oh no, the Fed's not going to pivot. And that's really what slowed this rally down. And I think has brought it to a stop. On Wednesday, when we get the CPI report, that report is going to either continue the choppiness because the market is undecided on what it wants to do, or the market's going to fall like it did here. And let me just point this out. This drop right here, this was the CPI report last month, okay? The day before the CPI report came out, that's when the contraction, moving sideways, the choppiness of the market, it's almost like the CPI data was leaked because we had this huge down day, down 2.38%. And then the day CPI report was released last month, the market dropped nearly 3%. And then the very next day, dropped another, what is this, 3.8%. So it just got worse and worse and worse. So I do believe market participants are being overly optimistic at this point in time. And that is the cleanest and clearest indication of an answer to your question. Market participants are overly optimistic. When the market is green, when the market goes up, that brings more people in. People FOMO into a rising market. Fear of missing out. That's what helped to accelerate this rally. But this rally, to me, is no different than the end of March rally we had, the snapback rally. The market got oversold, and then people got over optimistic. So it's not a simple answer, but I try to make it as simple as I can, with the fact that over optimistic, that view has caused market participants to not see what's in front of them. And when you have the government coming out and saying, you know what, this is a strong economy, when the government comes out and redefines what a recession is, and just instead of admitting that it's a paper recession, it's a technical recession, but the jobs market is strong, at least reverse looking. If the government would have been more upfront and honest, I don't think we would have had the over-optimistic view and the market front-running a potential Fed pivot. That just wouldn't have happened. And you have analysts on mainstream news talking about, oh, we've hit a bottom. And then you even have other YouTubers out there who are nothing but bullish on the market. Buy this dip. Don't miss out. So I'm trying to see everyone's viewpoint here and put it into my own market thesis. And I hope that's what you're doing as well. Take all the little pieces of information that you get all over the place, all over the internet and different mediums, and make your market thesis. I'm so excited for CPI. I am too. I am too. Okay. All right. So we got a little sidetracked there with talking, but that's fine. Remember, that's what I said. We are this live stream. That's what it's for. It's to answer your questions. So whatever it may be. All right. I just want to go down the line here real quick, and then we'll get back into other market conditions. But I want to go through the SPY and the Qs right quick. So when we look at the SPY, not a lot of difference from SPX. The weekly expected moves are up here. The top end is at 422.29. The bottom end of the weekly expected move is 404.65. So both of those lines moved up this week compared to last week, which makes sense. I mean, the market moved up too. Also, just like on the SPX, the SPY also came back and tagged its 5-day EMA, okay? So it is sitting right on that right now. And again, the 5-day EMA is starting to arch over and flatten out, okay? And with that flattening out, that makes sense. We've just been chopping around for the past few sessions. So not bad. As far as risk reward goes right now for the SPY and this week, obviously CPI on Wednesday, which is the consumer price index, and then PPI on Thursday, which is the producer price index. Those are two big data points that are going to drive this market either up or down, right? As far as CPI, it really hinges on how quickly can the lowering of commodity prices work through the economy and show up in the report. To me, that's the biggest question that I have for the CPI. I don't think it will come in hotter than expected. Like I said at the beginning, oil prices have come down dramatically. So that's a good thing. Also, lumber, like I said, getting down to under $500, that's like a 2-year low. So these commodity prices working through our economy and showing up in the report. Okay, we are at about a 50-50. It doesn't get any worse than that when we're trying to play the odds, or we're trying to manage our risk. And that's what one of the main things the weekly expected moves are. And for our investor community on Patreon, the daily expected moves. One of the big jobs of these numbers are to help you manage risk, right? For example, we know that 68% of the time, the market will fall in between these two purple lines by Friday, close of business. Where it goes during the rest of the week, and that's up in the air for the most part. Technical analysis can help us with that. But if it's just outside on the upper end, we know that it should come right back down into it. And it does that frequently. 68% of the time, nearly 2/3. So we've got that, okay? All right. So right now, it's sitting 50-50. Risk reward for weekly expected moves, 50-50. I think tomorrow is going to be another flat-ish day. I don't think the market's going to move anywhere. It could be a green day just because we're sitting on the 5-day EMA, okay? Since we're sitting on it, it could bounce off of that. We could have a green day. Maybe it gets up to 415, right? It's at 413.49 right now. So again, not a very big move at all in the SPY. Do I think we'd have a red day tomorrow? Going off of the 5-day EMA and looking at the past several sessions, the only time that it did that was back here on the 26th, this one red candle here. That's one time where it did dip below the 5-day EMA. But, I mean, I have to go all the way back to July 14th for another example of that. So over the past month, it happened a couple of times. So that shows us that most likely it's just going to bounce off of that 5-day EMA and fall somewhere within, this section here of the chart, and potentially being a green day that is pretty much flat, right? So not big expectations. Wednesday morning, not big on expectations either. It's Wednesday afternoon, 2:00 p.m. That's when it falls right there. All right, looking at the Qs, a little different situation here. It is actually slightly down if we go 50-50 for the market. Oh, excuse me with that highlighter. Click the right buttons here. All right, so the Qs are a little bit flat. It's a little bit more on a bigger reward at this point for weekly ranges, but it is bouncing and sitting on its 5-day EMA. And just like on the SPY, I have to go back here to the 26th of July, and again here, the 14th of July. to find candles where the market sold under that 5-day EMA. So again, another flat day tomorrow, potentially on the green side for the Qs. All right, let's keep going. Let me just pull up the Dow Jones here real quick. The Dow Jones has really been underperforming the rest of the market. But if we look here for the weekly expected move, I did not put the box in. The top of it is 333.73. The lower end is 322.21. So literally a $10 difference there. So that's not a big move at all for the Dow Jones. Okay, so, you know, we talked about CPI already, so I don't need to ramp on that anymore. We talked about Fed pivot. I don't need to talk about that anymore. So where should we go from here? How about today? Let me go to SPX. I'm going to load the 15-minute chart. Today, the market opened a little bit higher and held up relatively well, all things considered. There we go. Look at that for today. Yeah, it opened a little bit higher. All right, the candlesticks that are right in the middle of the screen, that's what we're focusing on right now. There was a batch of negative headlines this morning, in addition to some hesitation, of course, ahead of Wednesday's CPI report. Now, there was a notable absence in mega cap leadership, which helped to drive the market lower today. The main indices trended higher in the early morning. That's why we have that big hump there at the beginning of the day before losing its steam mid-morning and giving back all of its gains. Now, the market moved sideways from that point, closing just off intraday lows, just barely. But the big headline that I want to talk about here, now that I just quickly went through kind of the market wave, NVIDIA. I want to talk about semiconductors and NVIDIA here for just a moment. NVDA is the ticker. What did you talk about? NVIDIA. There you go. Great one. Great one. Let me do this. There we go. Oh, and I don't know if this is an annoyance or if it's helpful or what, but I didn't turn that on either. Okay, NVIDIA. Big headline this morning. Why? Because NVIDIA, well, it fell 6.3% during regular session. In after hours, it's down another percent. NVIDIA pre-announced weak Q2 revenue guidance that NVIDIA attributed to lower revenue from its gaming products. Now, the gaming revenue fell 44% quarter over quarter and 33% year over year. Now, I want to compare this to their data center, okay? Data center revenue rose 1% quarter over quarter and 61% year over year gain, okay? Gaming fell 33% year over year, while data center rose 61% year over year. So we can see where NVIDIA needs to focus, and it's not on gaming. And I do wonder how many, and we've talked about this before, it's probably been months since we've talked about it, cryptocurrency. You know, when crypto was big and it was talked everywhere and it was 40, 50, 60, nearly 70,000. How many people jumped into the mining business? They bought CPUs. They tried to build out their own mining rigs. Many did, thousands. However, I did see a report months ago when we were talking about this that showed cryptocurrency mining equipment was flooding the market, used, where people had bought from AMD, from NVDA, anywhere they could get their hands on these chips, on these processors, graphics cards, everything, to mine Bitcoin and other altcoins as well. Now those machines are flooding the market. You can find them for sale anywhere. They used to go for a pretty premium, but now you can get them relatively cheap. Is that a problem for NVIDIA, for AMD for that matter? I think it is. And I think that's why specifically gaming has been hurt at NVIDIA. Also, people going back to work, not being home, not being there to play their games. So why do I need to upgrade to the next biggest and greatest thing where my console is working just fine? So there are many, many things to consider in the semiconductor space. One other thing to consider is electric vehicles. They take up a lot of chips. There's a lot of computing power in an electric vehicle. Just look at Tesla, for example, if you want to dig for those numbers and find out how much computing power does it take. And then look at AI and how that's growing. How much computing power does that take? Quite a bit. I believe it's September 30th. I think that's the date, September 30th. Elon Musk is having a AI Day Part 2, or Tesla is having an AI Day Part 2. I believe it's September 30th. What's going to be revealed then? And how many chips and how much computing power is that going to take? So there's definitely demand out there. However, when you look at an electric vehicle, and I tweeted about this earlier today, there was a piece that I read that talks about the average electric vehicle is $20,000 more than the average counterpart ICE, internal combustion engine vehicle. So for the consumer, even with all the tax credits, even with those that are proposed that aren't quite there yet, it still doesn't bring the cost of an electric vehicle down to where the average American can buy one. They're still just too expensive. That hurts demand. So there's a fine line here with demand and supply in the semiconductor space. Many semiconductor companies have reported that their customers are not buying, and they're sitting on inventory. And unfortunately, in the semiconductor space, you can't really sit on inventory. It can degrade. There is a number of things that can happen to damage those chips. Then they can't use them. That's going to hurt margins. So there's a fine line here that we have to watch for. Those cards would go for around $4,000. Now you can find them for about $900 to $1,000. Yes, absolutely. Those Bitcoin mining machines, Ethereum mining machines, Cardano, whatever. Those mining machines were a big part of the demand for companies like NVIDIA. And they would use the same type of frame internals from a gaming computer in a mining rig, right? I don't know exactly. I don't remember the term that they use for those mining kits besides just a mining kit for Bitcoin and so forth. But yeah, that's a problem. So NVIDIA's weekly expected move, top side 199.8, bottom side 179.8. So it is outside of it. One positive that I would give NVIDIA is that it is on its 21-day moving average, and its 50-day moving average is just below that. So that 50-day moving average is at 170.23. So it's not quite there, but I could see it going there. Definitely. Today's 6.3% drop was a big drop, but it wasn't nearly as big as it could have been, right? And again, in the after hours, another percentage point has been lost. So I could definitely see it dropping to the 170. It's 50-day moving average, and then from there, we'll have to see how investors digest this information. NVIDIA, what was I going to say? Shoot, I lost my train of thought there. Let me just pull this up right quick. Pull the chart up a little bit. My buy box for NVIDIA, my goodness, why do I always do that? And let's just go ahead and clean this up too. My buy box for NVIDIA is still down there. I mean, it got there once this year, but that would be anything under 150 a share. And I wouldn't buy at 150, but that's when I would start, it's up on my screen and I'm monitoring the daily movement of that. Because maybe intraday, you get a long candle on the bottom and you can scoop it up for a pretty good price. So that's NVIDIA. Now, the news that NVIDIA shared, it had a ripple effect across the entire semiconductor industry. I mean, the entire industry went lower. Now, you can see that in the Vanguard Semiconductor ETF. Ticker symbol is SMH. We do weekly expected moves for a lot of subcategories, just like semiconductors here. Now, the Vanguard Semiconductor ETF is still within its weekly expected move, which is okay. The top side of that is 252.7. The bottom side is 234.4. So it is within that still. So that's decent. It has fallen below that 5-day EMA, which really gives it a bearish context here. But it is still above its 20-day and 50-day moving averages right here that are going in those directions. So that's also two positives, right? Okay, so we've got some short-term uncertainty here with semiconductors. If CPI comes in and it's rough and it hurts the market and brings the market down, then you definitely expect something that has been running as hot as the semiconductor sector to really pull back. So if we go here to July 5th, which was the bottom, to the top, which occurred right about here on August the 4th, that is a 29.2% move in this semiconductor ETF. That's a really good move. Now, this did drop 1.7% today, so keep that in mind with the pullback in the overall semiconductor sector. Now, what I want to say here, I think that's it for semiconductors. Oh, one other thing to mention about semiconductors. Since they did so poorly today, that led to the S&P 500 information technology sector to close in last place of the day, down 0.9%. And let me go ahead and put the sectors up here on the right-hand side, along with a few subsectors and the dollar. There we go. And the VIX. The VIX was not very much today, but it is still at 21.2. So we've got volatility. Okay, so there we go. You can see a big mix here with the S&P 500 sectors there of up and down. Now, other headlines in play at the open today included one, Fed Governor Bowman, who is a FOMC voter, said that she sees another 75 basis point rate hike on the table for the September FOMC meeting. That's pretty big. As a matter of fact, if I go and pull up oh, I added an extra letter there. If we go to the Fed Watch tool, okay, you'll hear investors talk about this. You may even see this chart pop up on the screen if you're watching mainstream media. It takes a minute to load here, but here's what's being priced in. All right, or what's the probability? The rate hike. There is no FOMC meeting in August. Okay. So there will be no rate decisions in August. This is going to stay where it's at. Now, the probability is building for the September meeting. And you can see up here, it says meeting date. Really hard to see up here. Meeting date, 21 September. And then what we have right here is a 36.5% probability of a 75-point basis hike. 75-point basis hike. And then over here, we have a 63.5%. Oh, my apologies. My apologies. It's with the light shining in my eyes, it's hard to see these numbers. Let me blow it up. There we go. All right. So there is a 36.5% probability of a 50 basis point rate hike. There's a 63.5% probability of a 75 basis point rate hike. So looking at the Fed Watch tool here, the target probability for the September FOMC meeting is leaning towards another 75 basis point rate hike. Do you think that's going to cause the market to rally when the market has front run a Fed pivot? I don't think so. Ladies and gentlemen, I do not think so. All right, let's see here. Let me hop back over to comments. They might have guided down at a perfect time. If CPI comes in, let me put this up on the screen so we all can see what I'm talking about here. They might have guided down at the perfect time, and we're talking about NVIDIA there. If CPI comes in lower, that way the market lifts it higher if we do rally on Wednesday. Very good observation and a good point. Very good point. As a probability, I could see that happening. I'm not sure if the folks at NVIDIA tried to time it with the CPI data, but it's an interesting thought for sure. And who knows? Maybe they did time it to meet up with the CPI report. Okay. The second piece of news that came out was the Senate. The Senate passed, and I just want to pull our normal chart up here, SPX. The Senate passed the Inflation Reduction Act, which features provisions for a 1% excess tax on stock buybacks and a minimum 15% tax rate on corporate book income. Although there is an offset for depreciated assets, I still think it works in the government's favor as far as receiving more tax benefits from companies, corporations. However, whether you like this bill or not, the Nonpartisan Congressional Budget Office, or CBO, said the bill would have an insignificant impact on actually fighting inflation. Now, this leaves me to believe that the title of the bill is just political theater. And whether it reduces inflation or not, it too would take time to work through our economy. Meaning, if the CBO is wrong and it does help fight inflation, but logically, I cannot see where spending more money brings inflation down, it'll still take time before it has any effect. Probably next year. All right. Now, the third big headline for today was that China unexpectedly announced the continuation of military drills around Taiwan. They want Taiwan in their grips. Will they move to take it? They could. They want to. I'm not a military expert. I do not know. But they are definitely flexing some muscle right now. And whether that turns into anything, I don't know. I guess there's two big factors. With China flexing their muscles, is Taiwan going to feel threatened and react to it? Or is Taiwan going to feel intimidated and react to it in the opposite way? And then I guess 3 is, what's the U.S. going to do? Will the U.S. sit back and let it happen? Or will the U.S. engage to try to prevent it from happening? I guess those are questions that we can't answer right now. Now, with the market moving higher this morning, despite these 3 big headlines, the reversal in price action was largely attributed to buyer exhaustion, I think, in a nagging sense that the market got too complacent with its rebound effort. Now, the complacent part, it hit home in the performance of so-called meme stocks or momentum stocks, and of course, other heavily shorted stocks, many of which saw huge percentage moves on no news whatsoever. Bed Bath & Beyond, ticker symbol is BBBY, triple B and a Y. Yeah, China wants Taiwan to make the first move, it seems. And that's a good observation, too. They either want the U.S. to mess up and somehow they couldn't use the Pelosi visit to their advantage except to provide cover or a reason to flex their muscle. And again, I don't think China wants to disrupt the supply chains and the manufacturing hubs of Taiwan because they need those just as bad as we need those. All right. I have a point to talking about these momentum stocks. Bed Bath & Beyond, BBBY. It was up. Let me pull it up here on the bottom right side so you can see it. It was up 39.8% during regular session, up another 12.2% in the after hours. Big mover. Will this move higher tomorrow? Probably. There's no rhyme or reason. It's just how many want to get involved and try to make a quick buck. When you hear people talk about 2020 turned people into gamblers on the stock market, this right here, I think, is an example of that. Being up 40%, 52% in a day, that's not normal market behavior unless there's like an acquisition, right? Let's look at AMC. Not as big of a mover, but its name itself falls into this category. It's had big swings. Look, last week or yesterday, I guess it would be. Yesterday, what is this? 18.8%. Today, another 8% during regular session. In the after hours, 2.8%. And these are just two examples. And there's many, many more examples out there. Now, they both saw well above average volume, despite no news catalyst. Now, here's my thought on this. When the speculative stuff takes off, just like this, let me put BBBY back up here too, so you can see that one again. When this happens, it's often associated with the end type move of a broader market rally. If nothing else, it forced participants to dial things back a bit, especially with the CPI report coming out on Wednesday. Another factor limiting the index performance today was the trailing of mega cap stocks. They just didn't ignite. The mega cap growth ETF, ticker symbol is MGK. It closed down 0.4% versus a 0.3% gain in the Invesco S&P 500 equal weight ETF, ticker symbol RSP, and the 1% loss in the S&P 500. Now, there were a couple of exceptions. Meta Platforms, ticker symbol MTA, Meta. It was up 1.9% today. And then we have, it's trading here in this perfect range, getting to the top of it here. I did not update the weekly expected moves here for them, but look at this purple rectangle that it's trading in. Boom. It's at the top of its range, so maybe this is an area to short Meta. So it comes back down to the bottom of this range that it's been in, going back to June 12th, June 10th. Then we have Tesla, TSLA. I love Tesla. I'm a little confused on price action for Tesla. I don't know if it can continue big moves, but nevertheless, and I have not updated the weekly expected moves for this, I usually don't do that until Wednesday to give our investor community on Patreon time to have the information, digest the information, and use it how they see fit. But Tesla here, it seems to me to be making a cup and handle pattern here. You know, it kind of swoops down like this, right? And then we have our handle right here, possibly. But both of these, Meta and Tesla, they were able to buck the trend today and close in the green with gains, leading their respective S&P 500 sectors. Communication services, which was up, let me pull it up real quick here. Sectors, just lower down here, up 0.4%, and consumer discretionary up 0.3%. They closed ahead of the broader market outside of the Dow Jones. Now we need to talk about oil. Oil is next here on my list. Let's look at that. US OIL, US oil, real easy to remember on TradingView. And if you want, there is a link in the description for a free account to TradingView. Doesn't cost a penny. Now, we talked last Thursday about oil and this green bar here, right? We talked about oil and it potentially bouncing in this area, and this was key. Oil below 90, that's depending on which side of the trade you're on. Below 90 is a good thing. Below 85 is a great thing. But it bounced. It bounced in this box perfectly. And quite frankly, to me, that's to be expected. Now, it is sitting just above $90 a barrel. And that's about where it closed today. It's down just 38 cents here in the after hours. But it was up 2.2% during regular session. This boosted the energy sector. And the energy sector over here on the right-hand side, I thought I got it moved there. There we go. The energy sector, it was up 0.5%, right? So that helped the energy sector, which closed near the top of the leaderboard here. Also, the 210 spread, it worsened today, or widened at the very least. The 2-year US 02Y, it's important to watch these. The 2-year fell 2 basis points to 3.2%. And it's sitting there now. You could round it up to 3.21% if you wanted to. But like I was talking about, there seemed to be a ceiling or resistance right here, because it got held up there a couple of times, but it broke through that yesterday with a huge 9.19% move. That was a big move. Now, the resistance on the 2-year is important to help try to keep this inversion from getting worse. But breaking through like that, I'm sorry, on Friday, not yesterday, it's not a good one. Not if we want yields to uninvert, right? Okay, and then the 10-year US 10Y, the 10-year fell 8 basis points to 2.77%. It's down even more in the after hours. Now, here, the 10-year, right, we want this gray bar to be support. Because if there's support for the 10-year and there's resistance for the 2-year, that's keeping them from spreading apart and making the yield inversion even worse. And the deeper it goes, my theory is, the worse the recession will be. Now, another yield to watch is the 3-month and 10-year. That is a Fed staple. That is not inverted yet, but it is falling down a cliff towards being inverted. And that will really light up the Fed saying, hold on, recession, recession. All right. Looking ahead to tomorrow, Tuesday, we're going to get the Q2 preliminary productivity report. The expectation is a negative 4.5. The prior reading was a negative 7.3. So we're expecting that our productivity has gotten better, more productive. And then we get the Q2 preliminary unit labor cost. The expectation is 9.3%. The prior reading was 12.6%. These reports both come out at 8:30 a.m. They don't have a huge weighting on the market, on whether or not the market is going to do better or not. But tomorrow, I think the market has a good chance of being green, but it's going to be a very choppy session, and it's not going to move much. That would be my thought. Because every market participant is going to be waiting on that all-important inflation number. That is what will drive this market. Okay, looking at the dollar here, and you can do that by looking at the ticker symbol is DXY, also called the Dixie. It right now is wedged between its 20-day moving average on the top and its 50-day moving average at the bottom. Now, many people have called the dollar done. They say that the dollar peaked already. I guess that would be here on July 14th. The reason I'm watching the dollar, it tells us a tremendous amount. It has this inverse relation with so many sectors and even the S&P 500. When the dollar is strong, the S&P 500 is weak. When the dollar is weak, the S&P 500 is strong. So when the dollar was dropping here from its high in the middle of July, the S&P 500 was going up. But now the structure is changing. Okay? Let's see. I want to get these two. There we go. One more. Okay. The structure is changing. Let's open up. It is no longer in this downtrend, right? This downtrend right here has been broken. Now, the dollar is rallying up with its 50-day moving average and its declining 20-day moving average wedging. What do you think is going to happen here with this wedge? Two things. CPI report, inflation, it's going to dictate the entire market, including bonds. This wedge, if inflation is high, this will spike up, okay? As a matter of fact, let me go back here just a little bit. All right. This candle right here, okay? That is when the CPI report came out last month. Inflation was hot. The dollar surged 1.2%. So if inflation is hot this time around, the dollar is going to go up like this, and the S&P 500 is going to go down. Okay, so it's just not the indices, it's just not sectors, subsectors, bonds, the dollar, crypto, individual stocks. It's not just one of those things will be affected on Wednesday afternoon, but all of them will together. Some will be moving in opposite directions of others as well. Okay, let me clean this these drawings up. Not too bad for drawing arrows. All right, cool. There we have it. All right, let's just look at Bitcoin and Ethereum here, and then I'll wrap things up. And again, if you have any questions, feel free to plug them in before we say goodbye for today. Crypto is strong. You know, on Thursday when we looked at this, I said, you know, we had another flagging pattern occur. That's what the highlighted green here section was. And of course, crypto broke out of, oh, come on. There we go. And of course, Bitcoin broke out of that flagging pattern. Now, there were a few flagging patterns I shared with our investor community on Patreon today for trade setups. They did not go anywhere today. One of three was positive. The other two were negative. But in our trade setups group, there were many that did fabulous, even with the market coming down. Okay, I see Bitcoin here. It's bouncing on its 20-day moving average, using that as support. That's a great thing. Maybe Bitcoin is basing and it's found its footing. Okay, maybe it's creeping up right now, but CPI comes out, the market gets hit, especially technology. Technology's been outperforming, and one way to look at Bitcoin is it is just like the technology sector with a higher beta. So it's going to move a bit quicker. And if you plug in the QQQ, you can see similarities in how it's moving. Not one for one, I'll give you that, but there are similarities at least. Sometimes I think, when I'm looking at my my phone at night and I see, well, Bitcoin's up here at midnight Eastern time, and a lot of times I say, you know what, that's what tomorrow's going to be. Sometimes it works out. I need to start writing it down and actually seeing how it performs, but it almost seems like, looking at Bitcoin is a leading indicator for how the QQQ is going to do the upcoming day. It's something goofy that I have discovered there. Now, Ethereum, it's moving at much bigger percentage swings than Bitcoin right now. It's still on a very hot trajectory at this point in time. It is using, just like Bitcoin, its 20-day moving average to bounce off of and find support for 1776 right now. That's incredible. That's incredible for where Ethereum is. It was up 60% over the past month. What is it now? 45%. Yeah, so that peak that occurred, July 28th, it's just getting back to that now. So incredible move for Ethereum. Just absolutely running it. 1776 right now. That's a good number, isn't it, for Americans? All right. Well, yeah, it's going to be super choppy tomorrow. I totally expect that. I'm going to go to the SPY here, and I'm just going to pull up the 5-minute chart. Let it load here right quick. And just looking at how choppy, look at today, where it started, where it ended. I mean, this is a nightmare for trading. You have to be very, very tactical in how you trade if you choose to trade in the chop. There's a saying about not trading the chop, and it's real. It can mess you up real quick. But another flat, choppy day tomorrow. That is definitely on my radar for how I think things could play out. Of course, outside of any big headline news that could drive the market one way or another, I think it's going to be sideways. I think there's a probability of it being green tomorrow, but just slightly. Just how today was slightly in the red, just based off of the 5-day EMA and how it's sitting on that right now. It could easily bounce off that and have a very small green day tomorrow. But Wednesday, obviously, that is the day that will decide everything for us in this market, at least for the next month, and until we get the next CPI report. And then we'll do this craziness all over again. So do me a favor, click that like button, share this video with a friend, and if you like this perspective, join us in beating this crazy market by clicking the first link in the description. You'll get instant access to our weekly expected moves, numerous trade setups, top 10 stocks in 4 different categories. Speaking of investors, watch your inbox. We'll have my updated top 10 growth stocks list in your inboxes this evening, market insights, and so much more to help you along your investor journey and becoming financially independent. So thank you for coming on this journey with me. I greatly appreciate it. I hope you have a wonderful evening. I'll see you back here tomorrow after the market has closed to talk about anything and everything, what happened, why it happened, and what to expect. All right. Thank you guys so very much for joining me, and I'll see you in the next video.